All right, everybody. Hello and welcome. David Kinder here, registered financial consultant, charter life underwriter, and I'm, of course, here with my co-hosts, Kurt Gibbs and Mike Moffat. Today's topic is going to be I think it's going to be a lot of fun. Of course, we're nerds this way, so go figure. But we're going to talk about some questions that a CPA asked on LinkedIn that are really good client advocacy questions. These are questions that every client should actually be wanting to ask. And by the way, the fact that a CPA asked these, I thought was really neat and rare because typically most CPAs will never admit to not knowing something in financial services or in anything financial at all. Generally speaking, I wish more would kind of take that approach. A lot of them think that they're pretty much the god of finance. They're great for taxes and generally great for tax returns. But it's so rare to find a CPA that says, I don't know enough about this. Can someone share with me what I need to know about this? So I'm going to share this post. And of course, let's see if I can zoom in. I want people to really see this here. Oh, that wrong thing to be zoomed. Okay, let's try this. There we go. So let's start from here. So this is Stephen Jarvis, CPA. By the way, he's really an open-minded kind of a guy. I really like being connected with him. So he starts off, let the firestorm commence. He knows he's going to get all kinds of opinions. I've never been pitched a life insurance product, and I'm genuinely curious about a couple of things. And while I can't promise you won't be bombarded in the comments for your sales pitch, I can tell you it won't be from me. I'd like to learn a few things here. One challenge of tax planning is explaining complex topics in a way that clients understand enough to make an informed decision. I think of it as drawing it in crayon. So we're both on the same page. Wherever we can bring clarity to the decisions, we're all for. Because if we make it too complex, who's going to make a decision that's good for them if they're confused, right? So we're on the same page here. So here are my questions. I think that he says, I think I know the answers to technically, but I have no idea how it's being drawn in crayon for a client when it comes to insurance. So he's got 6 questions. It says 5, but there's a 1A here. So there's 6. We're going to talk about these, but these are really good questions. So the first part is, what is the insurance company doing with my money? You guys want to start off with that? We go around the table here. What is the insurance company doing with your premium dollars?
Well, Let's just play. I tell you what, let's do. Let's play a little, just kind of a devil's advocate, client advocate. I'm gonna just be the client with this a little bit, and you've sat down with me, and I'm gonna ask those questions to you. You know, what does the insurance company do with my money?
Okay. We're role playing now. Okay, I see how we're taking this. All right, which means you just threw it back on me. Thanks, Kurt.
You're welcome. You're welcome. You are the Wikipedia for us all.
I don't know how to monetize that. There's got to be a way. Everybody says on the Google or the Wikipedia of life insurance.
We come
How
to
do
you
I use that?
Yeah, we come to you for the facts and nothing but the truth.
Okay, so there is a few parts to this question, and strangely enough, of course, I learned some of this from my CLU studies. And so there's a couple of parts here. The first part is that, especially initially, you're not going to see a whole lot of cash values in the beginning, depending on how your policy is structured. And even if it's structured for maximum cash values up front, it may not necessarily be in your best interest, depending on how the policy is structured for your long-term goals. So it all depends. And you're going to hear me say that a lot. It depends. I almost hate that phrase. Unfortunately, it's also true most of the time. So the first part is that even when there's little cash values, a portion of those premiums is going to post to a reserve. Because let's suppose that you die in the first year. And I'm stealing this phrase from the number one life insurance agent from many years ago. He says, the main thing you want, if you should happen to pass away the first year, you do not want a refund of premiums. You want the payment of proceeds. You want the death benefit to pay out. And so to do that, the company has to have reserves. And those reserves need to be invested. And we'll talk a little bit more about how they're invested. But the company needs to have that in their general investment account ready to go. Now, In addition, as your policy is growing additional cash values over time, all that. Come on, Mikey. You're. I swear, I'm going to get a logo that says Sparky says, and we're going to just say he's agreeing with me.
Oh boy. Well, we have our friend Alonzo Hall here in the chat, and he says that they invest at a substantially larger scale than the CPA could.
That's a possibility. That's leveraging the contract. But let's start with right now the properties of the contract itself right now. And so the contract properties is that when the money goes in, it posts to a reserve, and then it's building a cash value to build up over time. And you can leverage against that cash value. You could also withdraw that cash value. Now, that's not always known. And sometimes it makes better sense to withdraw the cash value than it does to borrow against it. And that depends on the type of company and the type of structure. And I'm going to put on the insurance nerd hat on here. It depends if the policy is a participating policy or a direct recognition policy versus a non-direct recognition policy. Yeah. And so when it's a direct recognition policy, what that means is that when we're looking to credit dividends to the policy, will it recognize that there's a loan against it or not when crediting a dividend? If it doesn't, then borrow against it so you can still get the maximum amount of dividends credited. If it does, then you withdraw down to your basis, and then you borrow against your cost basis from there. So, and that's to keep the maximum tax benefits of the policy.
I guess just to make that a little bit more clear, basically what you're saying is with non-direct recognition, you're getting credited on the full amount as if it had never been touched, as if there was no loan against it.
Exactly.
Absolutely true. Absolutely true. So and the only difference is that there's still an interest cost, right? There's always going to be a cost of borrowing money, because where is the money coming from when you take a loan? It's not coming from the policy. Your policy is being used as collateral for the loan. Then the loan's coming from the insurance company. It's so important. It's one of the biggest myths out there. It's like, well, why would I pay money to borrow my own money? Or pay interest to borrow my own money? Well, it's not your money.
Yeah, and that's one of the myths that you probably hear perpetrated the most by people that don't really understand how this works, is that why would I ever take a loan out against my own money? What they don't understand is you're taking out a loan from the insurance company against your future dead self. So why not use the cash in the policy while you're alive? It's called life insurance for a reason, right? Might as well use it while you're alive. But
Mike, you just threw a bomb there, because we didn't touch on how the calculation of life insurance works. But it's great
from a client perspective, like I stated, opening comment there. From a client perspective, it's very easy to get into the weeds with question one. I mean, it really is. So, to answer his question with crayon and pencil, so to speak, and paper, Mike, you just did a great job of doing that, where really that's that for the client, that's the nuts and bolts of and the gist of most of it right there.
Absolutely. Now here's the neat thing, is that this is how the three of us seem to really work well together here. So I explain the technicalities in the best way that I can, and then Mike is saying, here's the way to say the same thing in consumer speak, which I would eventually get to if we were one-on-one. But, I just love that you can take what I just said, because I explained the technicality and said, here's what it really means. Because I am going to go through the technicality on it, hopefully not too badly, but it is something that I do. And so when you said that you can borrow against your dead self, we have to know the formula for life insurance. And most people, when you ask people, how does life insurance work? They don't know. And I'm talking about agents. They don't know the formula. So I'm going to give the formula. In fact, I really should type this out and put it in a banner here. But the formula is net death benefit, whatever the end result is, right, is equal to your cash values, whatever they are, plus the net amount at risk. And that is the difference between the cash values in the policy and the death benefit, minus any outstanding loans against the cash values. So when you pass away, the loan is paid back from the death benefit, and the named beneficiaries, they get whatever's left over. So you could exhaust your policy's benefits yourself and be the largest beneficiary of that life insurance policy. I mean, wouldn't that be amazing? Be the largest beneficiary of your own policy, and you can just use that for yourself. And by the way, you might be wondering, well, gee, does the government know about this? Yeah, the government knows about it.
Well, and and that gets into also the thing that we see so many times on some of these forums and these chats, and some of these agents that you hear that question always: do I get the cash value back? At death, does my beneficiary? Well, that it's you really need to understand that's a component of the death benefit, and I think that's a huge miss for a lot of agents in explaining that to your clients. And I think that's something your client needs to understand up front, and in really every situation.
And in fact, Alonzo here, my brother from another mother, the easier analogy is borrowing the equity from your home. Now, we talked about Lending Tree, I don't know, was it two weeks ago, whatever it was. And Lending Tree has their ads that keep saying, don't borrow from the bank, borrow from yourself. I'm like, who am I writing the check to? Someone's writing you a check, and then you've got to pay back that money to a financial institution, whoever's lending those funds. So Lending Tree, I don't know why they're not in trouble on this, but no, I don't think anybody really cares that much. But when you're borrowing equity from your home, you're not literally taking out your garage door and saying, I'm going to cash this in. It doesn't work like that. It works that you have an asset that you can pledge for collateral, and however that asset is valued at, and whatever lender is going to let you borrow their money backed by that asset, so you can use that money on a not only usually a tax advantage basis, but usually a very low interest basis as well. Because often unsecured credit, especially these days, they tend to be far more higher interest costs than it is for secured loans, especially when you already own the asset.
And what is it we say? This is the one product that the lender guarantees the growth of the asset they've loaned against.
That's it. So, assuming that we're talking about a whole life insurance contract, because
exactly.
as our very first podcast, we talked about IUL, and we do have some concerns about that. Not that it's not a bad product, but there could be issues. But with a whole life contract, there's always interest and dividends being credited. Dividends are not guaranteed, but almost always there's such a great prediction, and it's very predictable on some of those things.
It's just your top companies that we've talked about before. They're just time tested. They have battle scars that have proven to be stand the test of time. I really do. They're 100+ year old companies, with dividends every year, except I guess you can go back and maybe look at 1929. There were some things obviously that took place in 1929 that would negatively impact almost every single thing.
And I think when they were first getting started, there might have been like the first 5 years there wasn't a dividend credit, but you're looking back in the mid 1800s for those periods for most of these companies. So the next question that goes with that, what is the insurance company doing with my money? Why wouldn't I just do the same thing with my money? Basically cut out the middleman. Why do I need an insurance company to do all this stuff? Why don't I just do this myself? What do you guys think?
Oh, wow.
Of course, Kurt, you're supposed to ask me that question, weren't you? We were doing
well,
both.
It's okay, but you just you can't do. You just can't do that alone. That's just not. You have to have. You have to have the insurance company involved in this type strategy, and the way this systematically has to work. I mean, I don't know how you really answer that other than the fact that you can't do that alone unless you're if you're a multi-millionaire and you're self-insured, and that's not a component that you're looking for. I don't know how you really answer that question. Go ahead, someone else.
We'll take the pressure off.
Yeah, I mean, I saw that right off, and I'm just like, how do you really answer that question?
Go ahead, Mike. What are your thoughts?
Yeah, I mean, if it was that easy, then why doesn't everybody do it, right? I mean, this goes back to the stuff that we talked about, well, several weeks now. If it was that easy, why doesn't, everybody retire with $1 million in their bank account or $10 million or whatever? If you're gonna get 15% a year, whatever the silly funds claim and do all this stuff. If it was that easy, I mean, I hear this all the time, and I think to myself, well, then why is anybody broke? Like, seriously, if I can get 15% every single year or 12% or whatever nonsense you want to put out there, why doesn't everybody just do that? That is a great question. Why doesn't everybody do it? Because, even if you could put $1,000 a month into whatever, and it's going to grow at, this mythical 12 to 15% compounding or whatever nonsense every year, why wouldn't you do it? You're right. That is a great question. I mean, but the problem is that doesn't happen because the average is different than the actual. It depends on the years, and it depends on the distribution, and it depends on all kinds of things. And, then people want to talk about dollar cost averaging. Okay, great. Well, the problem is that if it keeps going down, even, when we looked at Dave Ramsey's fund, it hadn't even really come back to where it had started at, even though they claim it returns a 12% rate. If you got in there that first year that we looked at, you still haven't gotten your money back, 20, 25 years later. So this is the problem with this stuff.
Yeah, you've got some great points there, Mike. What we're going to do is I'm going to separate the question a little bit, because what we're really looking at is how the insurance company is managing their general investment account. And then we also have the tax advantages of the life insurance contract. So let's look at institutional money management. What's neat about shifting the risk of the policy cash values to the insurance company. And I'm not talking about variable contracts, because those are a little bit different here. But if we're talking about a whole life or an index universal life, those are fixed contracts. You're investing in the general investment account of the company. And what's their time horizon when they're investing? They always have a time horizon of generally 20, 30, 40, 50 years, however long that time horizon is. If we think about individual investment management, we often have to tailor back our risk tolerance, because we're going to look to spend that money at some point, which means we're going to shift our allocation over time, not because of the investment, but because of the investor, the person who's doing the managing. I'm sure, Kurt, I know you've probably heard this rule. The idea of, the percentage of money you should have in bonds is like, or the percentage of money you have in stock. I can't remember which way it goes, but 100 minus your age is how much you should have in bonds. I think that's the way it goes.
That's it. Yeah.
Yeah. And so you're supposed to do that based on your age and your risk tolerance, not necessarily because of the investment. Whereas an institution, they're not doing anything based on age. They're doing it based on the investment quality. They're institutional money management. So that's one part, and it helps take the emotion out of the investment decisions. And then the second part is the tax advantages of the life insurance contract can't be matched. Now, this particular CPA probably doesn't understand or has ever heard of the capital equivalent value of life insurance. And this is where we basically say that if you have $1 in life insurance, it can spend the equivalent of $3 to $5 in like a 401k or IRA, if the contract is structured well to help you to spend that money. Now, if it's not structured that way, I can't make that guarantee and make that claim. But $1 in life insurance, because of its tax-exempt nature, can spend is better than $3 to $5 elsewhere. So having less money in the right place is more valuable than having 3 to 5 times as much money held elsewhere. And so that's why it's the tax benefits of the contract, not necessarily doing the investing on your own, but it's being able to have the money in the contract and leveraging the properties of the contract. So that's my answer for that one. But good job, that. Yeah.
I mean, not only that, but, if you want to make a withdrawal from your 401k or your Roth or any other, account to use while you're in these accumulation phases. I mean, we saw, what was it, a week or two ago, how much not contributing or taking a withdrawal hurts the accumulation. And if you're in your 401k and you take a loan, you have to pay the loan back, and you're not getting any more contributions or credit until you pay it back. And with a Roth, it works more similar to life insurance, but you can still only borrow up to your cost basis without incurring penalties and taxes. So you've got all kinds of issues there. And then with the advantage to life insurance is that you have no risk of loss, essentially, with with the building of the cash value, and you also have access to it. And like we mentioned a second ago, if it's with a non-direct recognition company, if you have $100,000 in cash value in there and you take out, say, a $30,000 loan, your $100,000 is still earning the dividend, and you're only paying the interest on the $30,000 loan. So now you've got access to capital whenever you need it, and all you need to do is pick up the phone and say, "Insurance company, send me the money," and you have it. Instead of having to go through all kinds of forms and worry about pulling money out of accounts and stuff like that, you just all you do is make a phone call, sign a piece of paper, and they send it to you. And now you've got access to collateral whenever you need it at a very good rate. And if you're with a non-direct recognition company, your entire cash is still earning a dividend. So I just get so sick of people online talking about all these things, and they have no idea what they're talking about. It's unbelievable, the misinformation out there.
It is, Mike, and to those points, I want to bring up something that happened yesterday. My daughter has been in church camp this week in our local town, and I've spent my mornings, taking her to church camp. So my thing is I like sitting in the coffee shops. I like coffee. Everyone that knows me knows that. So, I'm in a strange coffee shop yesterday, and I like to have conversation. When it's a good chance to have that about what we do and what we advocate for. And I talked with a gentleman yesterday, and I know there's numbers out there to back all this up. I haven't looked this up, but David probably he may have this rattled off the top of his head here just in a second. But it's amazing how many people are taking and have taken loans from their 401ks, and that's a different negative effect than what we've even talked about in previous episodes with anything about how that just kills the forward momentum and the compounding and everything that we've touched on. And you have so many limitations, like you said, Mike, with the amount that you can take. The guy he was up front with me. He told me, he said, I took about a $75,000 loan out of my 401k to do some things, and the consequences of that. After we had the conversation, he was really awakened to the fact that you could do something like this with the product that we really just are completely 100% all in for, because of the many ways that you can use it. And I used a term yesterday that instead of cash flow, I used dispense. I said, if you could dispense your cash a different way, as we got into the conversation. And it was really fun to watch, kind of the light bulb come on about some different ways. And obviously we had our circle talk and did some things, but we're going to talk at some point later on. But he was just, once again, like probably the CPA here that we're kind of referencing these questions, just unaware of being educated on different ways that you can do things that benefit you and not these institutions. I'm like, Mike, it just sickens me to continually, see some of these posts and, some of the language and some of the comments we see in these forums about, what can I do about this and what can I do about that? And borrowing from your 401k is just not a good plan at all.
If it can ever be avoided. And now I still got to back up the CPA a little bit, because all the stuff that we're talking about is not taught in CPA school. No one learns about this and quite frankly, most of this is not taught in my CHFC or CLU studies. It's just not necessarily taught. We kind of have to read between the lines and realize, oh, that's how that works.
Well, and two, I had a really good client of mine had an issue with her accountant before tax season this year, and we wound up in midstreams going a different route with her accountant and moving her with a different accountant, because he was not aware of things that really he should be aware of, even as a CPA and an accountant that doesn't even get into the weeds, like, some of the things with life insurance about, 72T distributions and how those are used and different things. And it was just, it's amazing. Like you said, it's amazing what the financial industry claims is the, kind of the holy grail of knowing things about finance, with the CPAs and the accountants, that they just are not familiar, the majority of them, with how these things work.
It's hilarious. You see these people on YouTube and TikTok and Facebook, and they all act like everybody has all kinds of money and they're never going to have a bad year and this and that, and everything's always okay. And, your money is always going to grow at 30%. And the market's the best, and taxes you're gonna pay lower taxes in retirement. Well, I don't know where these people get this stuff, but first off, you have no idea what the tax rate's going to be in 20 years. Second off, you have no idea what the market's going to do in 20 years. You have no clue about anything, but you're supposed to be a fiduciary, and you're supposed to, reveal all of these things and put the client's best interest first. You have no clue what anything's going to do tomorrow. And if you did, every single hedge fund and investment manager and everybody in the world would hire you to take over their portfolio if you knew what was going to happen even 5 minutes from now, because you would literally be the richest person in the world. Everybody would want to hire you. So for all these people to say, well, my account's going to be, if you just put $100 in whatever fund for the rest of your life, you're going to have $5 million in the next 20 years. This stuff is so ridiculous. I get so tired of hearing this. Anyway, I'm going to stop now.
Yeah, tell me how you really feel there, Mike.
No,
Wow. I mean, there's a rant. I think there's more to go there, but I want to get back on topic because we're already 27 minutes in. We've only handled the first two questions.
Anyway, so why do I hear so much negativity about insurance products, Kinder? Can you tell us?
Well, I gotta get back to number two though, because number two, and actually right before that, let me shout out to Alonzo here, because he says first, the scale that life insurance companies can put into place, they obviously have far more buying power and more borrowing power and whatever else that they're going to do in the general investment account, they could do far more in it. And because we as the client don't have that scale, we don't have access to some of those investment opportunities. And quite frankly, there are some areas that they can invest in that are just not necessarily available to the general public. So yeah, the size of the portfolio, and they have massive portfolios. We're talking multiple billions of dollars, and we're not talking, 1 or 2 or 5 billion. We're talking about tens to hundreds of billions of dollars in those kinds of accounts. So anyway, let's go into question number two. Nothing in life is really guaranteed. So how does this go wrong? And of course, our very first podcast, we talked about the IUL and what could go wrong with that. So I'm going to defer for IUL, that entire 1.5 hour podcast that we launched with, everything and anything that could go wrong. I think we pretty much covered on that one. But regarding whole life insurance, and I have to say that phrase again, it depends on the policy structure and everything that's being used for you. But generally speaking, as long as the client is making the scheduled premium payments, the only thing that could really go wrong is the dividend scale adjustment. And that's the only real variation, because dividends are not guaranteed. So what is a dividend? What makes that up? And there's a few factors. First of all, a dividend is declared each year by the company's board of directors. And by this is the biggest misrepresentation of whole life insurance. A dividend is not a rate of return on the policy. And if I've got an agent that is listening to this and you're saying that your policy pays 7%, you are misrepresenting unethically your company and your policy. There, I said it. It's annoying.
Do you feel better now?
Dividend. We're getting all kinds of rants here today, which is good. A dividend is a divisible surplus of the company's profitability. So what makes up a company's profitability? First is operating expenses. I want a company that keeps low overhead. Now, what that also means, it is something that, this is why we are doing a podcast, and insurance agents create their own marketing materials. I don't want the company doing that anymore. Let the company save that money. Some people say the company should have more public relations and combat all the misrepresentation. I don't want the company doing that. Why? It lowers their operating expenses so they can put more dividend performance back in the policy for people who believe in what it is we're trying to do for them. So I don't need the company doing all that stuff anymore. So it's operating expenses. It's favorable mortality, which is a favorable way, which is a better way of saying less death claims than anticipated. Okay. If we could put off some people's death claims, that means more money is still on the books, which means more of a dividend can be credited. The third one is in new sales. We need more people paying premiums into the company, increasing the risk pool, increasing, the total number of people that are insured. That helps the profitability. All of those factors and many more all help to create the profitability, which with that profitability is then distributed to policyholders. How is it distributed? It's distributed on, generally it's a proprietary basis, but generally it makes sense that it's based on the age of the policy, the size of the policy, the insurance rating of a policy. So for example, strangely enough, standard gets the worst dividend treatment as opposed to preferred, ultra preferred, preferred plus, whatever it is, and even compared to rated policies. Rated policies are worse underwriting because you have worse health, and with those cases, I'll say it rather bluntly, you pay more, we pay quicker.
Mm-hmm.
Because you're in worse health. Let's just think about it. The cost is the same. The problem is that you've got to put in more to make up for it because your life expectancy is lower. That's assuming you get an offer in the first place. So what goes wrong is that according to the dividends, if the dividend isn't quite there, will your plan of how you're leveraging your policy still work out? Now, I mentioned earlier that we use something called the capital equivalent value of life insurance. And yes, we include guaranteed elements in our predictions on what this policy can do. But when we think about it, even if the policy didn't quite perform as well, basically, how else would your other portfolio would have done? Because keep in mind, this is all still invested in corporate bonds and government bonds. Your stock portfolio possibly might not keep up either. Therefore, you still have risk in either way that you would go. But if dividends are just a little bit lower, all that means is that your cash flow, your predicted cash flow becomes less. Probably not by a whole lot. It's just a slight adjustment. Oh, well, nothing is guaranteed as we talked about, but at least the consequences of it not quite working out are far lower, and the difference is going to be so much lower, so much of a smaller difference. It's not going to make that big of a difference to your future lifestyle based on the calculations that I've done on these things. So that's my thoughts. That's the only way it could go wrong. If you need every single penny, well, quite frankly, I think your Social Security will probably continue to rise with cost of living increases and such. That'll probably offset any lower cash flow from your policy. That's my thoughts. I just went on a spiel there. What are your guys' thoughts on that?
No, I think that's a good way to explain it, and that's in depth, and that's the only kind of way I think you could answer that, because there are a lot of moving parts to these things, and from a client, kind of like I said earlier, playing from the client side of things, you need to know the nuts and bolts of things, and you could sit and question every single thing that's out there. We don't even want to get inside of a mutual fund prospectus and the fees and the things that are associated with that. If you want complexity, that's the conversation that's far different than life insurance, as we know.
Yeah, no, nothing to add. Let's go to the next point, or this is going to be a 3-hour show.
We're going to start going on more rants, aren't we? Okay. Yeah. So question number 3, or question number 4, technically. Why do I hear so much negativity about insurance products? Mike, I'm sure you've got an opinion on that.
Do you want another rant? Is that what you
Let's go for a 2-minute rant. What do you got?
I think that a lot of it goes to the fact that people always, a lot of times they don't understand exactly how insurance works, which is a problem. And people always look at averages and chasing rates of return. And if we understand oftentimes how those things work, that's not the only consideration to take into account. It is one, but there's also many others. Just taxes, for example, would be another. But I think that life insurance is a very misunderstood product in that it's not. I'll say this too, because I hear this a lot, is people try to pitch life insurance as an investment. And so people are expected to earn this outrageous rate of return. And to be honest, the rate of return is probably going to be zero, but it'll still spend better than anything else you could possibly be in. So the point here is that anybody that says that life insurance is an investment, first off, that's malpractice, because life insurance is by no means an investment. It's a source of collateral and also a death benefit in case you need it. But life insurance is not an investment. Why? Mostly because there's no risk. An investment in itself inherently implies risk, and there's no risk with life insurance. So not only is it not going to earn 1,000% a year or whatever stupid number you want to use, but it's not an investment either, and it's a source of collateral, and you can have access to it at any time. You don't have to worry about market corrections, or God forbid you lose your job and you need a loan or something like that, or to float for a while. All you need to do is pick up the phone and call the insurance company. They'll send it to you. So I don't think there's anything necessarily wrong with having other investments, and I would never say that you shouldn't have other investments, but to at least have a life insurance wealth contract as a part of your portfolio, to some degree or another, just for access to collateral. Not only that, but for other reasons like the death benefit itself, and maybe some living benefits that we never even talked about if the contract offers those. There's probably, I could rattle off probably 10, 15, 20 different reasons why having it as a part of your overall strategy would make sense. And I don't think anybody would necessarily recommend to only have all of your assets in life insurance. I don't think that that's a smart play either. So.
All right. Other thoughts? Kurt, what do you got?
Well, I think that's very well put and very easy to understand. And I would just add this, that from an advisor perspective, after being, kind of playing on both sides of the fence, I think everyone gets caught up in that chasing rates of return and that accumulation phase of being at the top of that mountain with this big pile of cash. And advisors want to keep that pile of cash growing because that's how they put food on their table. And it's sad, but it's a concept that's 100 plus years old. This has been in the tax code forever. And if it's done properly, it's just nothing's gonna spin like it.
Well, and to be fair, what advantage is it to your fee-based advisor to tell you that you can do this when it's taking their commission away?
Yeah, I mean,
why would they tell you about it? They don't want you to know.
Yeah, I had a guy just the other day that wanted to talk about a meeting, and he wanted to bring his financial advisor in on the call, and I said, he's not going to like this. This is this is not going to work well for you and for me and for him, because he wants you to keep he wants you to keep putting that $100,000 a year in that that series of bonds and stocks, and he's content with managing that, and he is not concerned at all about how you spend that money. Your money. He's not concerned.
Don't worry when it's down. The market always recovers, right, Kurt?
Yeah, exactly. And you're going to be in that lower tax bracket when you retire. Remember?
Don't worry. You're down 30%. It'll come back.
Yeah, exactly.
Yeah, volatility is the price we pay for higher returns, right?
Mm-hmm. Yeah, and and it gets into, once again, how much time do you really have? No, you don't. You don't know. You don't know any of that. Those are factors that you don't know. But where else can you put your money? It grow on a guaranteed basis. We know that side of it is obviously little to zero, but it does grow on a guaranteed side. But the death benefit that someone's going to receive, your loved ones at the end of time, what's that 401k balance going to do for you? For them, it's going to be a taxable event, number one, and I think that's the main thing to keep in mind with this is the alternatives and the strategies that go up against what we're advocating for here with, these limited pay strategies and products that we talk so much about. It's just, I just don't think people have enough education and understanding on it. If they did, and maybe that's, hopefully we're starting to get the word out a lot more about the facts that we can back up behind what we, what we advocate for, is going to bring a lot of people to get into that circle of that elite, 22% that we hear so much about. If you go back and you look at your information on it, the wealthiest 1% own 22% of all of this, and there's a reason why.
All right, so I'm going to take a step back on this, because the negativity is you guys have made great points, but you're also assuming that the negativity is against an ethical advisor. And there are some, and it's so easy to misalign some people, because quite frankly, they probably deserve it, that the insurance agent is only selling this stuff for the commission. Right?
Oh yeah,
it's so
you hear that
easy.
all the time too.
You hear that all the time, and they say, "Oh, you just want to make a big fat commission because you're not smart enough to get your securities licenses, or you don't want to bother with that because you want to fly under the radar of regulators." I've heard all that garbage so much, and I'm not going to say it's not true for some. But there are some people who see things from a different perspective that realize I don't need to do all that other stuff. I can still serve my clients the best way with having proper expectations. So the negativity is when someone's saying, I can get you this highest rate of return in a life insurance policy, like you talked about earlier, Mike, which was, they position it as an investment. When you do the real math of your premiums going in, and after 10 years, you might break even. I mean, our group, we changed the paradigm when we say the rate of return is negative. We completely change and reposition everything by just acknowledging that and coming to terms with that. Because once we say it's negative, and we still say you're going to be better off with your money here than elsewhere, we've completely pivoted the entire conversation. So much of the negativity is from, and it's from real experiences, that some insurance agents, they don't know enough. They're trying to pitch their product to people who are not asking enough questions. That actually creates victims of the insurance agent, and that's a problem. And we're not trying to do any of that. As I think you could tell, we kind of know our stuff. We've got a pretty good critical mind behind everything. So, but that's where the negativity comes from. And it's easy to then say, well, you just want to make a commission. Well, of course you're going to go down that route. Give me another one. I mean, we can play against that all day long. You just want your fee,
Right. And that's the dumbest comeback I've ever heard. You just want a commission.
Yeah. It's all relevant to who you're talking about or whatever from the advisor perspective. But David, we know the math on this too. This is we know that how fee-based people are paid, what they're paid on, and that they're paid whether it goes up or down. And it's just a play on some different words that are kind of used way out of context in most cases.
Guess what? I'm not going to even earn a penny on my commissions after 10 years. A penny. Your advisor is going to earn a commission for life on whatever the account balance is. So to tell me that I just want to make a commission is the most ridiculous set of BS that I've ever heard. When you understand how this stuff works, that I don't even know what to say. I almost just want to shake my head and walk away, because there's no talking to somebody. They don't even understand.
Well, and how many times have we heard people in our group that have talked about, and it's not every week that we have the call that this is mentioned, but it's probably at least once or twice a month on the calls. Is there's people out there that just refuse to not, I hate to use the word buy in, but that want to have a belief in this strategy working even after you explain so much, because they just think it's too good to be true. And those are the people we want to find out right now that don't believe as we do, because there's too many people out there that do want genuine help, genuine education, so that they can make that informed decision and not follow the pack off the cliff, so to speak. So, it's
Right.
just,
Those who get it and understand it do it. Those who don't won't. It's pretty much that simple.
it is.
All right, we're running lower on time. Let's go through questions 4 and 5 here. The illustrations look pretty and persuasive. How can I, assuming a consumer not in financial services industry, do my due diligence to know what to believe? And I'm going to start off with my answer first, which is that it's not necessarily about the illustration. It's more about the person who's giving you the advice and sharing everything with you. Are they going through the pros and cons? Are they giving you that higher level of thinking? Or are they just saying, look how pretty these numbers are? And you can tell if someone's really looking after your best interest, they're going to go through what are the things that can go wrong? What are the things that won't necessarily happen the right way? Though that tells me that that's an advisor who really wants to help you make a good decision and showing the positives and the negatives, the terms and conditions, and all of that. So it's not necessarily about the illusion or the illustration. It's more about who's the one that's interpreting it for you. Because let's be clear, the illustration is supposed to be a disclosure document, but no consumer understands the damn disclosure document. It's 30 to 50 pages, depending on which IUL it is. It's usually about 20 to 25 pages for a whole life policy. It's so much stuff in there, and it's written by attorneys to protect the insurance company. The client is at a disadvantage. They're not going to understand it. They rely on an insurance agent to translate and decipher this stuff to say, what is it in here that I need to know about? What are the stuff that you can kind of gloss over? What's the stuff that's like, this is a red flag or something to keep in mind? It's all about the agent and advisor. It's not necessarily about the contract, because ideally the right agent is going to give you a contract, an illustration that matches with what you said you wanted. And if it doesn't match up, I would hope that the numbers would show that it doesn't match up. I mean, for example, you wanted to pay for 10 years, but somehow it shows it for 30. That didn't match up. So you should be able to see some of that. That's my first response. What are your guys' thoughts?
Well, I'll go to the question itself. The illustration looks pretty. I don't know what illustration, he may have just, generically or in general terms put that out there, but I've not seen an illustration that necessarily looks pretty, if you know what I mean, from a numbers perspective, because it very well sound just in that language he may be looking at an IUL illustration, and yeah, you can make some things look, look pretty well, but from the strategy that we talk and we just totally, like I said, believe in so much. It's a concept, and you've got to understand that an illustration is just an illustration on paper. It's no guarantee of that it's going to be those exact numbers at the end of the day. And I'm talking about the end of the 10-year period, if that's the product that we're talking about, and that mostly is what we really believe in. Is you're not going to see a pretty illustration. You're not going to see the best numbers. You're not going to see that mutual fund type number with the average of 7 and 8 and 9 and 10 and 12% out there. It's not a rate of return product. What it is it's something that will benefit you far greater as far as the cash flow that it's going to create for you. Out 10 years past and until death, and for someone else from a death benefit, just maybe getting off on something a little different there by going into that, but the illustration is really not pretty unless it's kind of been altered, I guess.
And that's kind of where I like the example that I sometimes show people, how even though what I'm telling you will earn nothing over 10 years, it'll still outspend what you're doing, earning 10% compounding over 10 years. And I have the math to prove it.
Well, and Mike, it's just, it's so much that we've been drilled into everyone, consumer and advisor alike, your heads over time, that, the dollar cost averaging thing that you mentioned earlier, and, the start early and the systematic this, and so many things that are a myth out there about how your money really works and how the wealth of what you're doing is created works. It's so many moving parts to traditional planning that are broken. I mean, it's just it's a wheel with broken spokes in it.
Yeah. All right. Last question here. How do we, the insurance agents and the insurance company make money from this? So let's, I want to dispel this myth a little bit up front. The policy is not paying the commission. Your commission that compensates the agent does not come from your policy. That's unlike anything else in the commission-based world. So if you were to buy a car, the car is marked up to compensate a salesperson. You buy real estate, although I understand that they've reformed that somehow, but there's a new cap on commissions in real estate, but that comes out of the sale price. This is not built, it's not coming out of your contract. So here's what happens. Through the life of the contract, there's expenses in there. Now there is an expense, and it's paid by the insurance company. The company pays us our commission. Our commission is based on the policy, but it does not come from the policy. And so for the insurance company to actually make all that money back, they have to make that money back on the spread, which means they have to invest those proceeds, make more than what they've paid out, and then they keep the difference. And the validation period is sometimes somewhere between 8 to 14 years, depends on the policy structure and all this stuff. But the neatest thing is that the agent is not compensated out of the policy. We are compensated because of the policy. We're compensated by the insurance company for as long as we're the broker of record on it, but we are not paid out of your policy. It's one of the biggest issues that is just not understood. And I'm going to go a little bit on a rant on this. The Department of Labor does not understand this garbage either. Because what do they think? They think that when you buy an annuity, they called it junk fees, right? We got that White House notification saying, we want to cut down on junk fees in retirement planning. The fee doesn't come out of the annuity. It comes from the insurance company, and the insurance company pays the agent. The reason they call it that is because they think a commission which is compensation that is not direct from the client, the commission creates a conflict of interest. Maybe it does in the purest sense, but truly any professional worth working with is going to put solutions in place that are for the benefit of the client to help them solve their problems using our products and our expertise. Oh, I had to do that. Okay.
But do you know what? But do you know what does come out of your money is your fiduciary advisor's fee.
That's true. Whether the account goes up or down, it doesn't matter. That is an ongoing fixed rate cost against that portfolio.
Which is the most hysterical and hypocritical thing they could accuse us of.
Well, they look at the upfront versus the ongoing. And the law and the perception of the law, the perception of fiduciary duty is that a little bit over time is better for the client than an upfront commission to your agent. That's the perception. We have to deal with that perception, but it's stupid. But really, the investment advisor management ongoing fee is the first software as a service type of payment arrangement. It's the very first one. You'll notice that we don't pay for Microsoft Office anymore. You pay for an annual subscription. You don't pay, you don't own your software anymore. You're paying for it either annually or monthly or whatever. No one owns anything. And with the way the car prices are going up, I don't think anybody's going to own their car either. They're going to have that on a subscription. Quite frankly, Uber's a subscription. Well, that's not a subscription.
So basically, you're going to start leasing all your cars.
You're going to start leasing all your cars. Or actually, I remember Porsche, they had a thing where you could, they had a subscription where you can have access to whatever cars that they had for like, I don't know, $2,000 a month. And you can swap them out at whatever interval. I forgot, but it's a cool program. But you still don't own that car. Granted, with the way that cars age, I'm not sure if that's a great idea. I got off on a tangent there, but again, you're not owning anything. Whereas with these contracts, and that's the difference between contracts versus accounts, but the contract, you own it, and you have rights as a contract owner. You can still exchange those values to a new contract. There's so many other things there, but the compensation on contracts, quite frankly, it's like a cell phone contract in that the cell phone, if you went to actually, I always buy my cell phones on eBay and I just keep my same service. But if you actually went to the AT&T or Verizon store and you bought a 2 or 3 year contract and you bought a new iPhone, guess what? That guy got a commission based on the length of time of your contract, the size of your plan, and the phone that you got. Guess what? Life insurance and annuities works the exact same way. It's the same. You've got a long period of time. You get putting in a certain dollar amount, and based on how it's priced, I, as the agent, I get to earn a commission for placing that product with that company. It's the exact same thing.
Those evil cell phone people earning a commission on you.
I know, really, right? Yeah.
Pits of hell.
No, that's
So
a
anyway,
good, that's a good, I mean, that's a good way to put that question there, though. I mean, and to this guy that put these list of questions out there, I didn't see it catch his name up there because it's actually the first time I've actually seen the list. But a great set of questions, really, that should be asked. I mean,
Sure.
that's not very often do you get a series of questions that really are directly impactful for an advisor to need to know the answers to, and for the client to need to understand better. And from the crayon and paper side of things, that's a good way to explain a lot of these things. Break some of this up into little bitty bite-sized pieces where you can understand them as well as you can, and talk with someone like ourselves and people that are advocate for what we do, and get the best answer that you can get before you make these decisions.
Absolutely. And he closes out saying, clearly there are a lot more questions that would go into this, but these are the top of my list. I'm curious what actually gets said in practice by people doing this every day. I think, and that's pretty much what his post was. So he asked some great, brilliant questions. I think on purpose, I didn't put this to LinkedIn because, well, I want to see what would happen on my personal Facebook page, but I'm going to post the YouTube video. I'm going to tag him. And I'm curious as to what he's going to think of this entire podcast here, because we went through all of his questions rather in depth. Plus, his original post I already put a whole bunch of blog articles I was outlining a bunch of this stuff with. But these are some great questions. I hope that anybody who's not in our industry looks at those questions, and I hope that they appreciate our answers, that we're bringing in a higher level of thinking behind it. We want to show that we're trying to disclose everything as possible to make sure that people know that you can trust an insurance agent. You just got to know, is the person really helping you make a good decision? Are they helping to disclose everything you really need to know so that you can be positioned in one of the best ways possible? And of course, we believe so, but of course, we are highly biased in that.
Well, you could even look at the recent study by Ernst & Young, too, I think it was, right? Mm-hmm. That talked about you don't even have to have this, as the full part of your retirement plan, but even having it as a portion of it, what was it? They were able to spend 2 or 3 times the amount or something than the other person. I can't remember the exact, but just because they had a portion of their assets in a limited pay policy and used it as collateral, they were able to utilize that on the years that the market was down. And
the neat thing about some of those studies is that, I mean, they're interesting. Mm-hmm. And I know that Tom Hegna loves promoting the idea that we should always use third-party articles because, well, quite frankly, the article doesn't make a sale, but we do. I am still kind of biased to the fact that I love going straight to the source on some of these things. So I'm not always a third party. I like third party after we've discussed a topic. I've already researched it. I found the government resources on it, and I could cite something direct. And then here's the Ernst & Young and stuff. So that's just me. I'm a roots kind of a guy. I go to the root of some of this stuff.
Well, and I think the biggest thing too with anything that we've talked about in the past or today is, we're talking about something and concepts that they are in the tax code, and people need to understand that this is not an insurance company that has, been very crafty about creating an avenue to use this product. They have the product, and only a limited number of carriers do offer this, as we well know, and can make this strategy perform and create the outcomes that we get. But it's in the tax code, guys and ladies out there that are researching ways to do better with your money. It's in the tax code. We've got attorneys and CPAs within our own group that are from some of the, the highest schools that can be, you can go to for and get accounting degrees, and it's all backed by what's going into the tax code by people that are really well versed in this. We didn't come up with any of this on our own, but we definitely have the resources to back it up. And as David said, he goes to the root of things. And I think when he saw a lot of this, as we have all seen in the GAO reports and things like that, we just use it to our advantage. And that's what everyone that's a taxpayer should be aware of, that, you're entitled to every line and every page in the tax code. Whether or not you use that to your advantage is up to you.
Absolutely. All right, gentlemen, we're out of time. Thank you so much. Appreciate your time, and we'll see everybody next week.